Well, good afternoon, and welcome to today's webinar, talking about settlement and the T+1 change taking place in America. I'm very pleased that we've got a set of experts here who've done some deep digging into the implications of this change for the webinar today. Just by way of starting, first of all, to say a big thank you to our sponsors. We are very lucky at the FS Club to have a range of sponsors who enable us to run these series of webinars, and we are really grateful for their support as we range widely over finance, economics, technology, science, and other things that take our and your interest. You'll probably have met me before. I'm Mike Wardle. I'm Chief Executive here at ZN. My job today is to chair the session, but really to get out of the way so we can hear from our experts today. And just a few bits of housekeeping. First of all, the agenda is very simple. We'll have around 20 minutes of presentation from Gary Wright, Tony Freeman, and Tony Gandy, and then plenty of time for Q&A. If you haven't used the GoToWebinar system before, the way to ask a question, and you can do that at any point during the session, is to find the question tab on the GoToWebinar dashboard on your screen, type in the question, that'll come to us, and we'll field that during the Q&A. But please do put your questions in at any point during the session. If you do ask a question, we will pass some details onto our speakers so they can be in contact with you if there's a need for follow-up and discussion. And just to say that the session today is being recorded. This has the advantage that we'll post that in a couple of days up on our website, either so you can refresh yourself by going back and listening again, or so that you can share it with friends and colleagues who you think might be interested in the content we're presenting this afternoon. So it's my real pleasure to welcome to the floor today Tony Freeman, Gary Wright, and Tony Gandy, all directors of ISITC Europe, CIC, who were commissioned to do research into the implications of T+1 settlement. Gentlemen, the floor is yours. Really looking forward to your presentations.
Thank you very much. I'll click off very briefly. Can you see my slides there?
Yep.
Yep, great.
Thanks, yeah.
Excellent, good. Well, thank you very much for the invitation to talk to the group today. I'll kick off. I'm Tony Gandy. I was contacted, I would say about 18 months ago, maybe even 2 years ago, by ISITC to look into a contract that Swift were putting out for research into something that I admit that I am not an expert in, and that's the acceleration of settlement. Tony and Gary are clearly, world experts on this particular subject. I wasn't. I was coming in as an outsider to look at this subject. To me, a no-brainer subject. Let's look at the securities cycle, which Tony will do later. It seems obvious to most people, and it certainly seemed obvious to me, if we accelerate the settlement of shares, and other securities, we're going to have enormous benefits for the financial services sector. We're going to reduce counterparty risks, we're going to reduce margins, we're going to reduce the capital that these institutions need. So for me as an academic researcher coming in and joining the group to look at this subject, it seemed so obvious that what we would find were benefits to the financial services sector from accelerating settlement networks. That wasn't quite how it turned out to be. So in November, well, really October, I suppose, 2022, we started to do a number of interviews with people around the sector. We interviewed 44 people at major and smaller institutions, both on the buy side and the sell side of the industry. And we also talked to 46 people at workshops to discuss their views on the acceleration of settlement in the securities market. Very much this became driven by US announcements that they were going to accelerate their clearing system, their settlement system to a one-day cycle. And they would be doing this in 2023. Now, as the guys will discuss, there was a huge uproar about the short deadline, and the uproar has increased as the deadline for US accelerated settlement has moved to earlier in 2023 than maybe was expected. As I think we go through this, what we will see is some skepticism about the benefits of accelerated settlement, which seems incongruous to me, frankly, but is there and is real. And I guess the highlight from the research that we did was the vast majority of firms we spoke to, especially on the buy side, could not identify a business benefit of moving to accelerated settlement using the cycle that the Americans wish to. And that's a lot to do with the spinning globe and the fact that the US is the biggest place that we invest in the world. So how can we deal with settlement cycles which are not convenient for European and Asian investors? So that's all I wanted to talk about what I was doing. And what we did in May, we published a research report in collaboration with the University of Ulster. And that report is available from the Swift Institute website and indeed from ISITC and various other places. You can read that and see, yes, an outline of what the benefits of accelerated settlement are, but also a critique of it through the eyes of organisations that maybe some parts of the regulatory framework did not talk to before this process started. Is that okay, guys? That's a rather overlong start. I think what I'll do is turn to Tony, because I think Tony can describe what we're actually talking about. The cycles that we're talking about, but also the structure of settlement as well. Is that right, Tony?
Yeah, yes, that's correct, Tony, yes. Can you hear me okay?
Yeah.
Good, okay. Let's talk about when and where T+1 is happening. And I think the first thing I should say is that we have a fairly tight window to talk about this subject today. Our contact details are shown at the end of the presentation. So if you need to get back in touch with us and ask questions, please do so during this webinar, or feel free to get in touch with us afterwards. I'm a freelance independent consultant after having spent many years in the industry working at JP Morgan, Omgeo and DTCC. I was intimately involved in previous projects to reduce the settlement cycle from T+3 to T+2, both in the US and in Europe. So that's why, as was Gary, that's why we both look so haggard. We're industry veterans on this subject, which is the real way of describing what Tony called us. I think he said we were experts, but we certainly did do a lot of interviews. The amount of information, all those interviews were at least an hour long. I think we've got 50 or 60 hours of transcripts. So it was a wealth of very useful information. So let me tell you briefly what we did. When and where is T+1 happening? Many of you will probably know this already, but it is happening next year in 2024 in the United States. India has already moved to T+1. China has a hybrid T0 T+1 system, which is very difficult for overseas investors to get their hands around in the Chinese market. And the UK is working towards a T+1 objective. It has not made that decision as yet. There is a task force called the Accelerated Settlement Task Force, sponsored by Her Majesty's Treasury. I'm a member of it. Gary's also a participant. And the direction of travel is very much towards T+1. I think we're living in an era where quicker is better as far as policymakers are concerned. You know, if I order a new Fitbit, I can have it delivered by Amazon in 4 hours, and I live in Hampshire. You know, it's not like I live in next door to the warehouse. So the general policy objectives from a very high level are that faster is better. Faster equals less risk. Less risk is always good for the market. And very much the background theme, this isn't clearly stated very often, very much the background theme in the UK discussion is that the market isn't as automated, and Gary will talk about this a lot later, isn't as automated and technologically advanced as it should be. And if a T+1 objective spurs that investment in better technology and process, well, that's a good thing. So the rest of the world is watching very carefully, but the general direction of travel is a shortening of the settlement cycle on a global basis. So Tony, let's move on. Okay, this quote from John Reed of Citigroup. You need to be quite old to remember John Reed of Citigroup. So I'm sure there are people on the webinar today who weren't even born when he said this. I think this quote is from the 1990s, early 1990s, and he said that nothing good happens to a trade between execution and settlement. And I thought he was wrong then, and I think he's still wrong now. Lots of good things happen to trades between execution and settlement, because you've got the whole middle office process to tidy up the trade and enrich the trade and complete the trade before it can settle. So in basic terms, everything goes through a three-stage process. Tony, if we move on to the next slide. Now, this is quite a complicated diagram, which I'm not going to go to in great detail, but there are three phases to every transaction. There's the execution phase, which number one at the top of the top yellow box. Number two, followed by the middle office process where a trade gets completed. So the trading process is really quite simplistic. What's the instrument, date, time, quantity, price, etc., etc. You then need to add in all the settlement details, foreign exchange aspects can complicate things greatly, as I think Gary will talk about it more later. And you need to resolve mismatches. And this is absolutely one of the key crucial findings that we highlighted on during the research project that we did for SWIFT, is that the market didn't, most of the market didn't fundamentally improve its processing when it moved from T+3 to T+2. It tweaked its technology, it upgraded its operations processing, but the existence of the T+1 window to resolve any mismatches is extremely widely used. So best practice in the market is to try and achieve real-time confirmation and finalization of a trade on trade date. That's what people say they would like to achieve, but it isn't achieved universally, nothing like it. In fact, there has been improvements in the US market getting ready for next year, but the latest statistic I saw from the UK market is that about 70% of trades are done on trade date, 30% are not completed on trade date. They rely on the T+1 window to be completed and instructed for settlement purposes. So that's not viable in a T+1 environment. Everything has to be completed on trade date in a T+1 environment. Then the third phase is the actual settlement process itself. So this whole mechanism has evolved. It wasn't designed. It's not something that you would get a top marks for if you were writing an MBA paper on how to design a settlement system. I'll briefly mention the subject of T+0, although that's not the focus today. There's quite a lot of chatter about why can't we have real-time settlement? Why can't T+0 settlement be the standard? One of the reasons is that this process flow cannot work in a T+0 environment. It isn't primarily a technology issue, it's a process engineering behavioral issue. And people who tell you that blockchain can sort the problem out, for example, I think I'm missing the point. There may be benefits to doing it that way with new technology, but it isn't the fundamental reason why T+0 settlement is today probably impossible, and even if you tried it, it would be horribly risky. So there is a three-stage process. It's fragmented. Tony, if we move on to the next slide, I think we've got the issues with the process here. So the process flow is sequential, multiple handoffs. Each entity is entirely dependent on the prior entity in being given the trade, and everybody has their own version of the trade. So there are multiple breakpoints and reconciliation issues. There is no consolidated record of a trade available to all participants in the market, all people involved in that trade. Broker dealers generally match trades twice. They match trades for confirmation purposes with their clients, and then they match them again within the CSD for settlement purposes. There are complications to do with settlement internalization, the netting process, which is very beneficial in terms of encouraging volume and reducing risk, but what's traded is not the same as necessarily as what's settled. So there is a complicating factor there. And a high level of automation does not imply efficient and timely processing. We found in our research that you may have the technology, but you may not be using it in an optimum way. So, for example, if you're still using a batch processing model, you've got the capability to do real-time processing, but you're batching up trades to the end of the day or the morning of T+1. You're not using the technology in an optimum way. So therefore, just having the technology doesn't solve the problem on its own. And as I said earlier, and I'm repeating myself for the last point, the market is very reliant on T+1 remediation of problem transactions to get a trade into the shape it needs to be into for the settlement process to take place. Tony, if we move on to the next slide. Some key findings, and I'll shortly be handing over to Gary. But so firms across the world recognize the significance of the T+1 migration. Sometimes they took some persuading to recognize the importance of it, just how foundational it is. But I think that message is definitely sinking in. The FX issue is very real issue in the market. The foreign exchange is T+2 settlement cycle, generally. Can be quicker, but generally it's T+2. And as Tony said earlier, the US market is the most international market of them all. By value, approximately 40% of all activity in the US market is done by overseas investors. And that means a vast number of foreign exchange transactions. Therefore, it's that's a big issue that needs to be resolved. It isn't well enough understood in our view that the what happens in the US market affects the rest of the world. One of the more interesting aspects of the decision-making process in the US by the SEC was that they didn't appear to take a lot of notice of the rest of the world. It was treated very much as a US domestic issue. But it was recognized, I think, generally by almost all participants that where the US is going, everybody else is likely to follow because they are setting the trend here. And markets such as the UK and the EU, for example, don't want to be seen to be less efficient, more structurally risky than the US market. So there is a competitiveness angle here in that, having a shorter settlement cycle is regarded as a market advantage. It makes you a more advanced market.
And sorry, Tony, if I could just interrupt that diagram. Yeah. It's a sentiment diagram. And so what we were asking people was, what is the significance to you of T+1? Is it, and is that negative or is that a positive significance to you? And unfortunately, a lot of people responded that it was a negative issue for them over the coming year or two. So sorry, I just thought I'd explain that.
Yes, no, thank you, Tony. That is useful. The direct benefits of a reduced settlement cycle accrue primarily to members of the clearing system, and the numbers being put about in the US are big. The direct clearing members, of which there are a relatively small number in comparison to the overall number of participants in the market, they will get big cost savings by having a one-day cycle and rather than a two-day cycle. Now, whether or not those cost savings trickle down to the rest of the market participants is an open question at this point in time, or will they just get absorbed? But if you're a Japanese insurance company with a very big US portfolio, and that's quite a typical scenario, you're not going to see any direct benefit of a reduction in settlement cycles. You're going to see increased operational difficulty, which Gary will come on to in a minute, because of the time zone issue, because of the foreign exchange issue, etc., etc. So misaligned benefits was one of the key sentiments that people expressed during the research. That hasn't had any impact whatsoever on whether or not this is a good idea, to be frank. The policymaker perspective at a very high level is shorter settlement cycles are better, and therefore let's get on with it. And if that means people have to invest, improve their technology, improve their processes, well, so be it. That's a good thing as well. So, okay, let's move on because we're time is progressing. I think at this point, Gary, I'm handing over to you.
Thanks very much, Tony. Right, Tony's just gone through very quickly some of the issues in and around T+1, some of the benefits he's talked about around T+1, and this is a snapshot really of a presentation which we could spend all day talking about, literally. So we've highlighted some key aspects to fit into this particular presentation. But just for an example, the diagram that Tony showed about the front and the middle office flow, that's only part of it. It doesn't include the settlement, it doesn't include the foreign exchange, it doesn't include the payments, and that's only one firm. It obviously has multiple firms across the industry, all doing the same thing, multiple systems, multiple databases. In T+1 world, which is really real-time processing, everything has to work 100% on trade day, otherwise we get settlement fails. One of the issues that Tony raised just now was around the reason for doing this. There is no cost-benefit analysis from the US in doing this. This is a reaction to a regulatory failure with GameStop that precipitated the T+1 or the move to T+1. Now, whether this would in a GameStop or in a sort of Robinhood scenario, T+1 would mitigate any of that, I'm doubtful. It might have reduced it somewhat, but it won't stop it. So regulatory failures are not going to get stopped because of a change in the settlement time cycle. There has not been a clamour, as far as we're concerned, through the research that we did on a global basis. We did not find one use case that says investors will benefit from T+1 or real-time settlements. Investors are not asking for it. They're not clamoring for it. They're not knocking on the door saying, well, we would like to have real-time processing. We want to settle our securities one day after the transaction. Issuers equally are not clamoring for it. They couldn't give too much of a hoot, really, around what the market does, as long as the shareholders are being cared for and looked after, and providing the transparency of the securities on the register is available to them, so they can check who owns their shares at any given time. Now, in this instance, T+1 does help because on the register at a faster date, because settlement is faster, they should be able to get a better, more accurate figure of who actually owns their shares. So I think we can give that a tick in the box that the issuers will get some benefit out of this. Potentially, they could narrow the record date, the book's close date, and the X date on corporate events. Now, this is a two-edged sword. It means that they could get any proceeds of capital raising faster, but if they, on paying out dividends, they will also lose their money faster. So it's kind of swings and roundabout benefit. Yes, there is a benefit, but there's also potentially a cost. Faster capital raising is a benefit, so they should be happy with that. As I say, for the faster dividend payments, they won't necessarily be too happy about that. Anything that differentiates one market against another market is not normally a good thing for anyone bar the market that's leading. So the US as a capital market could well strengthen as a result of them moving one day faster than the rest of the world is able to accommodate. And of course, politically, that is something which in the UK and in Europe is not deemed to be a very good thing. From an issuer standpoint, does that mean that issuers then think about moving their listings from the UK over to North America? The fear of that happening is pushing, I think, the UK government to say, well, we must at least follow very quickly the North American move to T+1. I say North American because it is Canada, and not to forget Mexico. ESMA recently announced that they are doing what looks more like a cost-benefit analysis to see when the EU could move to T+1. Now, politically, that might take a lot longer than the UK could move. Tony mentioned about the UK task force and their report due at the end of this calendar year, and that will give some high-level headlines about when or if the UK should move. I think most of us believe it's a foregone conclusion that we will move. It's just a question of putting a date on it. If we follow the US example, it will not be a managed move. It will be every man for himself, or every firm for themselves. They will have to decide the best way possible. So when we talk about markets and issuers, we're often talking about the most liquid, largest organizations, but of course the most capital markets are, in volume terms, have a whole load of small to medium-sized firms as well, with not less liquid, or less liquid, and not necessarily would they see any move that lessens further liquidity of their shares in the market as a good thing, further pushing them potentially to move to a larger, more liquid market. Okay, Tony. Now, investors, that I mentioned, that they are not hammering on the door asking for this. T+1 is really real-time processing, as Tony mentioned earlier. It means you've got to get everything in your systems, in your database, absolutely correct, as near to the execution of the transaction as you possibly can. Now, that means investors or their agents have to operate much faster. It means that any errors on the database at the investor's agent or stockbroker or wealth manager or whoever they are causing will create a failed settlement at the other end. The UK stockbroking community, quite often, I mean, they're still operating very much like they did in the 80s, operating with Winterflood and Peel Hunt, and Winterflood and Peel Hunt acting as market makers or jobbers, as I would put it, will bundle and execute transactions the other day. It means that any of the stockbrokers or their clients that are still operating in certificated form will have a heck of a struggle to be able to make a T+1 settlement. Therefore, fails are almost inevitable coming from this neck of the woods. And because we operate in a supply chain in this industry, it means a failure at one end is going to create a failure at the opposite end. There's potential for funding or unknown funding FX costs or charges. In the UK world, this might come from exchange traded funds or other collectives that have exposure into the US market, where what we get here is on redemption a mismatch between what would be redeemed on T+1 at the moment and what would be redeemed on T+2, potentially an FX deal in the middle of it. So it depends on the issuer and the contract, or the terms of the contract, whether the investors will have to pay an increased charge for covering those added costs. And of course, in terms of FX, that one day you're on market risk as well. So it goes into the box of unknowns at the moment. It's potential that investors could get these charges, and there are a number of regulations which stockbrokers and agents in the field would have to talk to their investors and talk to them about what may happen and what may be heading into their bank accounts. and possibly they could brokers and fund managers could take a view and just say, okay, we'll incorporate any unknowns and just raise our overall charges. One of the issues that we didn't talk about earlier, but I think is relevant, is the stock borrowing and lending aspects and the potential impact on liquidity within smaller companies. Through the research, we found a number of lenders that said it wouldn't be economically viable to lend stock on a T+1 basis. The operational costs would be too high, so they would consider withdrawing the less liquid stocks. Withdrawing less liquid stocks means less liquidity in the market, means investors may well be in a position where they can't settle, they can't sell, they can't buy the securities that they want. Again, it's an unknown. It's a potential, I would say, and it's logical that could materialize if lenders withdraw from the market. Okay, Tony. Can you move it on to the next slide? Or is that the last slide? Okay. Look, we might, there was a heck of a hoo-ha going on the last few years about buy-ins. That is where securities can't be settled on trade date, and some days later, an automatic buy-in was deemed to be the conclusion. The markets, not unsurprisingly, railed against that, and it was put down rather than automatic on a case-to-case basis. However, in a T+1 world, we might find that this comes back, this automatic buy-in may well come back, in which case this will penalise investors quite severely if that should happen. Again, we will have to wait and see. Brokers need to contact their investing clients and explain to them exactly what may be happening to them, bearing in mind that unknown charges, unknown costs, unknown risks to an investor are a regulatory no-no. So that has to be covered, I think, by the agent speaking to their investors and taking them through what is going to happen or what might happen and what they're doing to make sure that their interests are protected. The abolition of paper certificates is long overdue. This is maybe a problem for some that like to have paper certificates, but really today we should digitalise and we should get rid of paper certificates. So although some people that's a problem, for me this is a huge benefit if we can eliminate the paper certificates finally. The data issues I mentioned earlier about the multiple systems and databases that these transactions go through, reference data has to be 100% better than what it is today. There's still far too many transactions that fail to settle because of somebody's not updated their data at the time of the transaction. Therefore, it fails to settle for whatever reason. So investors and their agents need to operate in a much more efficient way. So if an investor moves or dies unexpectedly, they need to have things in place to make sure that their financial commitments are continue and are settled. Potentially, this really goes back to the ETF issue again. If it's possible that given any market situation, any difference between markets, arbitrage opportunities exist, it's normal for markets to come up with solutions which quite often are products and are money-making opportunities. So I wouldn't rule out that portfolios and funds and new products may, for a time, emerge to cover the risks and the costs that are being exposed by having a different time settlement in the US or North America than UK and Europe. One thing to finish with, this is very much an international issue as much as anything else. And the problems are magnified through time zones, and the problems that we're discussing are really based around North America moving to T+1 at the end of May next year, May 27th, 28th next year, and what will happen after that. But of course, when the UK moves, could be Easter 2026, or EU moves sometime after, then these problems will exist in our own domestic markets as well. So it's time really that people got their heads together and tried to work out how they're going to deal with this.
Thank you, Gary. I mean, when we were considering our research, the two things that stood out for me is, my goodness, this industry uses a lot of faxes and a lot of end-of-day Excel spreadsheets sent by email. That kind of shocked me. So how are you going to accelerate your processes if you're still doing that kind of thing? The other thing that really stood out to me was, is this really a problem? Well, a European fund manager explaining if they were going to rebalance their portfolio of banks. So we sell, say, a German bank to buy a US bank. Well, if the US is settling in 1 day, Europe is settling in 2 days, plus there's a foreign exchange process that's going to take 2 days. If we sell in Europe to buy in America, does that mean we're going to be out of the market for quite a few days? What implications does that have, and how do we fund that situation, or do we not bother? So those are the two things that really stood out to me. This is not as easy as it seemed.
And the implication, Tony, is that there would be a higher cost to run the fund and an impact on the performance of the fund. So it's potentially a negative for the underlying investor, the average Joe in the street, or an institutional investor in those funds. But those increased costs are very opaque. They're difficult to track. How do you allocate the cost of funding? In the research, actually, our friends at Ulster University came up with a formula to which is way beyond my mathematical skills to describe the cost of pre-funding a trade. But the cost is one thing. It's where do they get the money from? Fund managers generally don't have any ability to borrow money. They have they don't have much capital themselves. So are custodians and broker dealers going to lend the money to the buy side firms so that they can fund those positions and at what cost, and therefore at what impact to the performance of the funds themselves,
while still maintaining segregation?
I agree with Tony. The problem is with this whole project is that it's being looked at from one dimension. It's not looking at it from across the board. And it's like when we look at the risk elements and reducing risk on the sell side, on those close to the central market, it's actually risk transference. We're not eliminating risk, we're moving risk. And the same with the costs and the charges. We save on one side, but we're actually moving it down the line to other parts of the market.
Exactly. And we're saving on financial risk, we're reducing margins, we're reducing counterparty risk. But by accelerating processes which may not be ready for acceleration, maybe we're creating more operational risk.
Yeah, absolutely.
What do we do if our systems go down for a day? Does that mean all our trades are going to fail?
Well, I've got an overarching concern, which is, as we've finished the research, the analyst goes on, and it's about market resilience. And this sort of comes very close to the ZN view of markets. Maybe there should be another view that's looked at this: is can the markets actually operate in this, operate in a near real-time environment, and how do they cope if a major player suddenly goes offline? If there's a cyber attack at a clearinghouse or a major custodian, what happens when we're all operating at 100 miles an hour and all of a sudden a major truck sort of stops immediately in front of us? I mean, what goes on? I mean, obviously a crash in those circumstances.
The traditional argument would be at least there's only half the number of trades in flight at that moment. But then you're substantially decreasing the time that you have to sort out that disruption. So again, the transfer risk.
was going to interject, guys. Dan Feeney's asked, I think, a really pertinent question, which fits into the discussion we're having. It said Ripple tried to take down SWIFT, and RTHS Global is trying to use atomic settlement and real-time liquidity to end correspondent banking. And he asked the question, beyond the tech, isn't the real issue the different incentives between sell and buy side in the T+1 scenario? Is that really what's going on? And I guess a follow-up for me is, we're talking about increased risk, and whether actually one way to do this is to use insurance products rather than lending. And just like your views on both those things, is this a different incentives between sell and buy side, and is there a role for insurance products?
Yeah, it's one of the things which through this year, as the market started to sleepily wake up to T+1, where people have started to look a little bit more deeply and become aware that the knock-on impacts of this are not simply about operating faster or having faster systems. There is, if you take a day out of the process, which is like a catch-all day at the moment, it's a kind of wash-up day that we have a day after the transaction for any errors to be cleared up and repaired, ready for settlement the following day. Well, once you take that out, then you're squeezing everything into short hours after the transaction. And internationally, there's a deadline in New York which has to be adhered to. Otherwise, you miss your deadline, you're going to get failed trades. Now no one is really looking at what happens on the buy side and what happens to investors. If these scenarios happen. We were at an ISITC conference a few months ago. We presented this to two major investment banks and said, what happens if you've got buy-side investors that are simply unable to settle and causing you fails? And they said, we won't deal with them. Well, I beg to differ, because I would hate to go into the front office and tell my trader that you couldn't deal with his favourite firm because that earns him a fat bonus because they can't sell a few trades a year. It's got to be something a little bit more sophisticated than that, I think.
I think the question is very good. Different incentives, different thinking. I mean, clearly to the central firms, there are big financial savings here. There are big margin savings, potentially capital savings as well. I used to be a bank supervisor, so I love the idea of capital being removed in one place so we could allocate it to a different place, of course, never give it back to the shareholders. Yeah, so there's big advantages there, but with the buy side firms, if they're going to have to be dealing with exceptions at 4 o'clock in the morning in Frankfurt, or here at 3 o'clock in the morning here, 4 o'clock in the morning in Frankfurt, that actually doesn't create a lot of extra costs. Now, if competition works, it's still going to be a benefit for the whole system because the savings of the central firms should flow through the custodians and the brokers down to the fund managers, etc. Yeah, we'll see if that works. But at the moment, what they see is, potentially extra costs, extra processes, extra shifts will have to take place. I mean, and you're right about insurance, but how much insurance are you going to pay on a piddling little, £500,000, €500,000 trade? There's not a lot of money in it in the first place. So, how much insurance are you really going to pay for it?
Mike, the other aspect is that I wouldn't portray this as a broker dealer versus client type conflict. The number of big firms that are members of the clearinghouse that will accrue those direct financial benefits is really quite low. They are the big flow monster firms, and as the people who will see a significant benefit might be measured in 10s or 20s, whereas there are hundreds of broker dealers out there, many of whom are clients of those clearing firms within the clearing system. So it isn't just an extra cost to the buy side, it's an extra cost to anybody who's a client of the clearing member, direct participant in the clearing house. So I think it's and there's no clamour from those people, the indirect users of clearing, for a reduction in settlement cycle. So I don't think it's an accurate portrayal to say it's buy side versus sell side. That's there's a much more nuanced way of looking at it than that.
Well,
I think also, Tony, there's the US market operates and structured very differently to the UK market, and very, very differently again to the across the EU. So we're not actually matching like for like. There is major differences. Yeah,
indeed.
I'm really sorry to bring the discussion from them, but we have run out of time. Fascinating topic, and many thanks to you for that. I think a message for those of you involved in the market is certainly prepare for the change in the US. You should have been preparing already, but also be watching out for what's happening in the EU and UK, and assume that you will have short notice once decisions are taken, and there's a need to plan for what will happen. So just a few thanks to give before we close. First of all, again, to our sponsors. We really are grateful for the support you give us in running this webinar series. And looking ahead, we've got on Thursday, operationalizing ESG biodiversity. Next Monday, state-sponsored sport corruption. And on Tuesday, enabling capital to bridge $1 trillion SDG gap. So some really good content coming up. Thank you so much, Tony, and Gary. It's been a fascinating session, and we'll be watching this space very closely over the next year or so to see how things develop. But thank you so much for your insights this afternoon. It's been a real pleasure. Thank you.
Thanks a lot, Mike.
Keep in touch.